Hi there. Welcome everyone to our Pellegrini Financial Market Update call for 2024 first quarter. And really, it obviously we ended 2023 with a good finish. Q4, of course, as we talked about last time, was a great finish to the calendar year for 2023. That momentum kind of carried on to 2024. And so when we look at the first markets in general, I got a little chart here for both the Canadian sectors and global equities generally. But in the Canadian market in particular, we had obviously healthcare and energy that shone, and both performed obviously quite strongly through those first 3 months of the year. Detractors was mainly communication services, and that's a little tougher in Canada. It's a small marketplace, I guess, and the constituents aren't very many, so it can ebb and flow quite dramatically like that. Because communication services actually in the U.S. and globally were actually a decent performer through the first quarter of 2024, not so much here in Canada. When we look at the equities globally, again, U.S. markets have been talked about lots, and they were the strong performer as well in this first quarter. But obviously, I've highlighted there the Japanese Nikkei market that was the strongest performer in the first quarter of 2024. Markets across really the globe were quite decent throughout. Canadian markets kind of in the mid-range category. Chinese market down a little bit, but generally strong growth throughout. And so, again, a good start to the 2024 calendar year. Obviously, in the US, much of that growth was tied into the large cap companies, the technology companies, and that's kind of where the earnings was focused as well with those kind of corporations, and they certainly led the way. When we look at just commodities in general, oil markets, which kind of ties into that energy component of the Canadian market, obviously performed well in this first quarter. So we saw kind of a run up in the price, from the low 70s or start of 70 roughly all the way up to 85 and a bit. It's obviously retracted a little bit in the last month or so. But obviously, that was a benefit to the Canadian market, the energy space in particular, which arguably is still maybe underpriced, although globally energy markets still have probably a little tough time in attracting capital and attracting investor capital sometimes as well. But it was a good start for the year for them. Gold, we haven't talked about gold for a long time. Probably the last time, as I mentioned before, was really the gold always had a tough time getting through that $2,000 an ounce threshold. And as you kind of see in that bottom chart there, it reached there a couple times, fell back and reached and fell back. And finally, in this last month, more or less, in a month and a half, gold kind of broke through and broke through quite dramatically all the way up to 2,400. It's again retracted a little bit since then. Again, I don't really lay too much into gold. Obviously, it has an influence on gold stocks in particular for a period of time. They're quite temperamental, I would say, to gold prices. So those kind of things are short lived, and you enjoy them while you can. But otherwise, it's asset as a whole, probably one you trade, you not really hold on to. When we move on into just some economic numbers, you know, the Canadian marketplace, obviously we didn't hit a technical recession, but our growth was anemic enough that probably felt like that in some ways. Growth rate now still is quite slow in Canada and is expected to kind of improve as we get through this calendar year. Obviously, recessions through England and Germany and Japan actually were all technical recessions. Again, they're on their way to recovery here, slower growth to the start. The U.S., they talk quite a bit about U.S. growth and how well it's going down there. Yes and no. Obviously this top chart here looks at the manufacturing index, which is one of the kind of broader indicators of where economic strength is going. And so while we were trailing up here a little bit as of late, it kind of pulled back here in this last month, just passed into quarter two here. But um, U.S. markets as a whole have also been driven by a lot of fiscal deficit, I guess, by the U.S. government. So they are spending a lot of money to make this growth happen. So on the back of debt necessarily isn't a good thing. Consumer spending has still been strong in the U.S. as well, and that's where you've seen a divergence between the Canadian and U.S. markets, where Canadian consumers, especially tied to mortgage debt, and both economies are tied to a lot of mortgage debt. The 5-year mortgage amortization cycle for the Canadian markets has a big influence on the consumers being a little bit more cash crunched than their US counterparts who have a 30-year amortization schedule. And that makes it a lot easier for the US consumer to absorb, obviously, rate changes to the mortgage market. So that's been part of it. That obviously has driven markets as a whole to some extent in the U.S. And I mentioned obviously the last quarter that the U.S. markets are markets in some segments who are stretched from a pricing perspective, and they still are. This bottom chart kind of illustrates that segment where just a price earnings ratio, you have to kind of bypass the COVID years there, but historically, we are at a high level of a PE ratio now in regards to where markets stand. And again, markets in the US in particular, of course, are driven by big tech in particular. There's segments obviously that aren't overpriced, but as a whole, there's probably some overpricing that is occurring in the US market currently. And that's what that bottom chart is somewhat indicating. When we look at inflation, as we talked about that in the past, obviously, I hate to say that the inflation battle is won. These two charts here really show where core inflation has gotten down into that kind of range that the central banks are looking to see or achieve, both U.S. and Canada, and these are Canadian charts in particular. The biggest chart on here on the right, I would say, is that ex shelter, so outside of housing, inflation certainly has come down. Inflation is still very sticky and very challenging in the housing sector, rent markets, and so on. Obviously, there's a lot of demand that's still there. Obviously, we've talked about, or the governments have talked about catching up on housing and all this kind of stuff. That's yet to happen, of course. So you're still seeing a lot of inflation in that respect. But for the other factors, it does seem to be somewhat tamed. And this is kind of a similar story, I suppose, in the U.S. So, well, I wouldn't say the battle's won necessarily, but certainly the central banks and Federal Reserve are feeling more comfortable where inflation is at currently. When we look at what the Federal Reserve, in particular down south, is doing, monetary policy generally, they have been doing a few things, in particular to the money supply, which is this chart on the left here, that has been slowly declining for the last couple of years. Money supply again is when you see a reduction in the money supply, that is kind of like an interest rate hike. It is disinflationary as you pull money out of the system, and so the government has been doing that in the U.S. Again, it's kind of similar through the European markets and so on. And the intent is still to drive that money supply downwards as they should, and you can see it rose dramatically there way back in 2020 at COVID. Um, will they get down to that level anytime soon? Obviously not. But if they keep the tapering going down in this right direction, that's a good thing. On the right hand side is kind of the Federal Reserve fund rate projection over time here over the next few years. And so, the Federal Reserve rates, Central Bank of Canada rates have stayed stagnant here for the last number of months. So we haven't seen any, obviously, rate increases. Obviously, we haven't seen any rate cuts yet. And we'll talk about that in a second. But the expectation is, of course, that rate cuts will come here through the later portion of this year, probably in Canada first before the US. Perhaps one or two rate cuts, a little less than maybe what they were expecting previously, but that will come. And as we kind of talk about what we see going forward, the fixed income component, which we didn't talk about too much here in this go around, what was essentially a flat performer in quarter one. While we view fixed income as a very positive component as a whole, it certainly is more so going forward in the sense that really markets adjusted to that. Really, the central banks moved to kind of defer rate cuts and probably reducing the number of rate cuts that is expected so far. So, like I said, uh, you know, rate cuts in the states might not happen until September, perhaps. They may not even do that if they're trying to avoid a recession or the election down south. In Canada, that might happen sooner. But either way, in both markets and Europe as well, there's probably fewer rate cuts coming in the near term than what was originally projected, which is why fixed income markets didn't perform too well in Q1. But going forward is still very much a positive component in the future here. Equity markets, again, probably expecting to see a bit more volatility here going forward. Obviously, we had a retractment of equity markets here in the first month of April here, or the first month of Q2. I would still expect some of that to happen here in the near term. Again, markets are probably a little bit frothy, so seeing come that off the table a little bit isn't all that surprising. Um, but equity markets generally, again, this is an election cycle year, so again, governments do what they can. Again, this is the U.S., but do what they can to ensure economies still flow regardless of what's going on, and so they that influences investment markets as well to some extent. Also, we always talk about technology, and artificial intelligence is still a big component of this economy and the future going forward. And that will drive a lot of the equity markets, in particular technology, obviously, but across the board, because AI is becoming so much larger in various components and through various sectors. And there was another chart I saw, I should have grabbed it maybe, but um, just showing the growth of what artificial intelligence will be doing within these various components of the markets and the economies. And so that will obviously lend well to equities as well, of course. And so, near term, I don't expect too much from equities, but longer term in this current year, I do. And so I think that'll be a little later in the year, but equity markets, I think, will do just fine as we move on. So I think I'll leave it at that, but I do appreciate you joining us here for this first quarter call for 2024, and we'll welcome you back in Q2. Thank you, and bye for now.